Educational note. This video is for education and research only, not investment advice or a recommendation. Past results don't predict future outcomes. For decades, you were told a simple formula was all you needed to retire safely. 60% in stocks, 40% in bonds. It was the bedrock of investing, a strategy so reliable it became muscle memory for millions. But what if that bedrock has a massive crack in it? In 2022, that safe strategy got a serious shock. An inflation spike and rapid rate hikes upended the market, and something happened that almost never does. Both stocks and bonds, the two pillars of the 60-40, fell hard together. The cushion didn't work. The rulebook stalled. Now, did it bounce back? Absolutely. The 60-40 saw a strong recovery in 2023 and 2024. But the damage was done. A critical vulnerability was exposed. The 60-40 is a static hands-off approach in a world that is anything but. It just sits there. But what if your portfolio didn't have to just sit there? What if it could adapt? What if you had a rules-driven engine that signals when to press ahead, when to slow down, and when to step aside entirely? That's not a fantasy. It's a newer class of adaptive strategies. And in this video, I'm going to walk through a high-level overview of one such engine, strictly for education, so you can see how a modern approach may navigate today's markets when the old rulebook fails. To understand why so many investors are now looking for alternatives, we need to go back to that wild ride in 2022. The 60-40 portfolio delivered one of its worst calendar year results in modern history, with common variations down about 16% to 17.5%, depending on construction and data source. Why? The core idea behind the 60-40 is simple. Stocks and bonds often move in opposite directions. When stocks go down, bonds are supposed to go up, acting as a cushion. For years, this pattern mostly held. But in 2022, it broke down. Inflation and fast interest rate hikes created a setup where both sides were hit at once. Stocks and bonds moved together instead of offsetting each other. The safe side wasn't safe. This wasn't just a blip. It exposed a weak point in the strategy's main defense. Even with the strong rebound since, that event was a wake-up call. Research from major asset managers and independent firms has argued that fixed allocations may be less effective going forward. We may be in a stretch of higher variability, and a simple fixed mix might not be enough to stay resilient. Investors are realizing they might need approaches that are more dynamic and can adapt. The problem isn't just one bad year, it's that the 60-40's flaws were laid bare. First, it has no direct allocation to guard against inflation shocks. When inflation jumps, both traditional stocks and bonds can struggle. Second, it's hands-off. It has no mechanism to dial risk down when markets look stretched, or to re-engage when conditions improve. You just hold on and hope. In 2022, hope wasn't a great plan. So, if the old 60-40 is showing its age, what's the alternative? It's not about finding a new magic ratio. It's about shifting from a static allocation to a dynamic, rules-driven system. I want to show you one example of such a system, which we'll call the Modern Adaptive Risk Asset, or MARA, strategy. This isn't just another set-it-and-forget-it portfolio. Think of it as an engine with two layers of rules designed to actively manage risk. Let's break it down. The portfolio structure is a bit different. Instead of a 60-40 split, it uses a 60-30-10 allocation. 60% is in a core equity driver. This could be a broad U.S. stock ETF, for example, SPY, a large cap tech ETF, for example, QQQ, or even a lower volatility fund, for example, SPLV. Examples only, not endorsements. 30% is in high-quality bonds. And here's the crucial difference. 10% is allocated to a slice of real assets. This could include things like gold or energy. Again, examples designed to help buffer inflation shocks, the very thing that hurt the 60-40. But the allocation is just the chassis. The real power is in the engine, a two-layer system of rules built on an adaptive trend signal designed to react to market conditions. What drives the signals? We use an adaptive trend line that adjusts to market speed and noise. In calmer markets, it filters. In fast markets, it reacts, without the lag and chop you get from basic moving averages. You don't need the math, you need the outcomes. Cleaner entries, cleaner exits. The Mara system uses this adaptive line in two distinct ways. Rule layer number 1, core trend signal. This base layer runs across the entire portfolio, equities, bonds, and real assets. When conditions show sustained strength, we carry exposure. When conditions weaken, we dial exposure down, sometimes toward cash or broad market defenses. This is a major step up from the 60-40. Your bond and real asset slices aren't idle ballast. If those areas trend down, the engine cuts exposure instead of simply absorbing the hit. Now, building a system like this takes more than grabbing a couple of ETFs. You have to track signals regularly and be disciplined in execution. We publish daily educational research with model state snapshots for members. Education only, not recommendations. Hypothetical checks have limitations. It runs the calculations and shares model state updates each day. Educational research, not advice. If you want to see the engine in action and receive these research notes and snapshots, there's a link in the description to learn more. Join the Substack to get the daily Mara research notes, the snapshot image, and the charts delivered by email before the open. Educational, not financial advice. But even if you don't join, understanding this next layer can change how you think about risk management. Rule. Layer number 2, adaptive bands. This second rule applies only to the 60% equity portion of the mix. And this is where adaptive risk control really shows up. On top of our adaptive trend line for your chosen stock ETF, the system adds flexible guardrails above and below that line. These guardrails create a normal channel for the market. Here's how the rule works. If the price closes above the upper rail, it's running too hot. The system doesn't stay fully exposed. It marks the equity slice off. Cash. That locks in strength when crowds get greedy, helping avoid riding a round trip down. If the price closes below the lower rail, it's washed out. That's often a sign of capitulation. The model flips the equity slice on, aligning with improving odds. As long as price stays inside the rails, the model maintains the base trend state from layer 1. Think about what this does. Instead of holding stocks through thick and thin, you get a clear, non-emotional rule for managing your biggest source of risk. It marks the equity slice off when greed runs hot and on when fear is rampant. Let's put it together. In 2022, as markets broke down, a static 60-40 just sat and sank with both sides. An adaptive engine like Mara, as an illustrative model, could have flagged the equity slice as off when the adaptive line broke. It could have signaled reduced risk in bonds as well. Then, when price moved below the lower rail, the model state could have shifted on for a potential rebound. Hypothetical illustration. Results vary by implementation and are not guarantees. That's the difference between a static rulebook and a dynamic engine. So is the 60-40 portfolio really dead? While headlines love drama, the reality is more nuanced. For many, a simple 60-40 allocation is still a reasonable starting point. Over very long spans, it has provided balance. However, the financial world is changing. The assumption that bonds will always offset stock declines has been seriously challenged. As a result, many large firms discuss being more dynamic and considering alternatives. The 2022 shock showed a key weakness of purely static approaches. They can't adapt. The true replacement for the 60-40 isn't another fixed ratio. It is the idea of dynamic risk management itself. A rules-driven engine like the Mara system with its 60-30-10 structure, its inflation guard slice, and its dual-layer adaptive rules reflects that evolution. It offers a framework for making decisions based on data, not emotion. It seeks to defend capital during downturns and compound it during healthier trends without guesswork. The old rule book, a fixed mix left to sit, fit a simpler world. For the world we live in now, you may want an engine that can better navigate the storm. Let me know what you think in the comments. Are you sticking with the 60-40 or exploring more adaptive strategies? And don't forget to like and subscribe for more deep dives into modern investment strategies. Join the Substack to get the daily Mara research notes, the snapshot image, and the charts in your inbox. Educational content, not investment advice. Link in the description. Subscribe for data-driven breakdowns of trade, tech, and money. Signals, not slogans. History rhymes. Power rebrands. Stay inquisitive.